Should bond investors be very afraid? Bill Eigen thinks so. I'm Jack Otter, editor of BARRON'S.com. I'm here with Bill, who is the portfolio manager of the JPMorgan Strategic Income Opportunity Fund, a real mouthful there.
Yes, it is.
So Bill, first of all, could you just give us your outlook of the bond market, where we stand right now?
Yeah, well, as you know, bond returns are basically mathematically generated. In other words, you make money in bonds and bond funds when interest rates fall, and when what we call risk premiums, which are how much, for instance, investment grade corporate bonds or high yield bonds yield over treasuries, compress. When both those things happen, you get very nice returns. The problem with that is that the closer and closer these things get to zero, the more you're guaranteed to lose money.
Because not only are you not getting that yield,
exactly,
but at some point the rates are going to reverse and you actually lose principal.
That's exactly right. And unfortunately, we've been in an environment for the past 3 decades where rates have really done nothing but fall. And they're currently sitting very close to the lowest levels they've ever been. In fact, globally, rates are just about the lowest they've ever been in history, so the closest to zero. At the same time, currently, and again, this is not last year or the year before, currently, you're sitting with risk premiums for areas of the market like high yield, certain types of sovereign debt, emerging market debt, investment grade corporates, all the nice sectors that people like to diversify in. Currently, those risk premiums are at very close to the all-time tightest levels they've ever been, at a time when fixed income volatility is at, not at a 5-year low, not at a 10-year low, all-time low.
And when you say risk premiums, what you mean is people are simply not getting paid very much to take risk.
When you look at the high yield market, otherwise known as the junk bond market, these are companies that typically find it hard to finance themselves. They typically run with high leverage ratios, pretty risky companies for the most part. And back in 2008, your average high yield bond traded at about a 20% yield premium to treasuries, okay? The tightest that level has ever been, okay, in history is around 2.75% back in 07. We're currently sitting right at around 3. So it gives you an idea of how close we're coming to the all-time most expensive levels ever for that asset class. I don't know about you, but I don't like to buy things that are really expensive. I'd rather wait for them to go on sale and then buy them.
Now, you're the first person I've ever heard actually describe the bond market as a fraternity party. Can you explain that analogy?
Whenever anyone who's ever gone to a fraternity party or a cocktail party of any type, if they've always stayed till the very end, they always regret it the next morning. And right now, you're getting toward the very end in the life cycle of some of these asset classes. It doesn't mean they won't be worth owning again, but when those risk premiums get incredibly tight, it doesn't make sense to own them. So if I do own them, I'm going to take the opportunity, while liquidity is incredibly good, like it is right now, to sell them. I'd rather clear out now, while the getting is good, from some of these riskier areas of the market, focus on maintaining capital, focus on hoarding cash, focus on short positions, which can protect my existing long positions, along with taking outright market risk, which relies on, again, rates to fall and risk premiums to tighten to earn a return.
So what do you recommend for the individual investor who's trying to figure out what to do with the fixed income portion of their portfolio?
Fixed income has been in a 31-year bull market. You and I both know that if equities went up for 31 years in a row, there would be no such thing as a hedge fund industry, right? Because people would think equities can't go down. It's kind of the attitude you have generally in fixed income. But the math dictates that you have to lose money in fixed income at some point, particularly if you think this economy is going to grow like it's currently doing, particularly if you think inflation fundamentals are going to improve, and also if you think the Federal Reserve, who's really been controlling bond prices artificially for some time now, is in the exit stage, which they clearly are. All those factors point to headwinds for fixed income. People who own fixed income right now in the traditional sense need to think about getting more diversified into alternative strategies, alternative areas of the market, and not just focusing on treasuries, agencies, investment grade corporates, the traditional areas of the market that they've been in for a long time.
That's how you used to define diversity, was corporates, junk, whatever.
Yep.
So now it's cash and being short?
By definition, when long positions get very expensive, short positions become incredibly cheap. It's never been cheaper to protect your portfolio against loss, essentially, over the last decade than it is right now. So I'm focusing there. I'm focusing on holding liquidity, because one thing I do know, as we saw last May and June, when volatility becomes unhinged even a little bit, it always is worse than we think. And things get mispriced very, very quickly. There's not a lot of liquidity in these markets when things turn, and that's when someone with liquidity like myself can essentially set the price and reposition their portfolio to take advantage of these newly minted levels, if you want to call them that.
So you have about 60% cash right now, and you're holding that, looking for those opportunities in the future.
But I absolutely will not take risk in areas of the market where I'm getting paid the least amount in history to own them. That's completely inconsistent with absolute return principles, and so I can't do it.
Thanks very much.
Sure, thank you.